Hi, everybody. Welcome to Friday morning. Market is about to get off and running, and obviously, it's been an interesting week. A little bit turbulent. That's not really too surprising given what the news has been. Really quickly, let me just cover one small housekeeping item. Then I do want to start talking a little bit about what is happening in the market in a broad sense. And then we'll start to go over some of the positions that we have open right now and talk about what all of this action really means right now. Really quickly, I want to just point out a couple of ways that you can communicate with me and with the Rebel Income community. If you are on Discord, the easiest way to communicate with me is actually directly through the app. You can send me a message. Just go to direct messages. You will see a list of all of the servers that you are subscribed to on the left-hand side. You can just select that server and send them a message. You can also take advantage of the open discussion channel that I've created. Now, this is an area that I created just specifically for the those of you who have access to this live stream on a live basis, so that you can communicate with me, communicate with the group as well, to talk about whatever is on your mind related to the markets, possibly open trades that we've been working with, and just share perspectives, experience, thoughts, etc. You can also message me here. I watch this channel throughout the course of the day and try to respond as quickly as I can. If you are on Substack, there's a couple of platforms that I'm operating on right now, and whether that's because I want to be able to come to you with whatever format you are comfortable with. So if you are on Substack, you can once you're subscribed, you can message me directly. But also, let me see. Just go here to chat, and you'll see all of the people that you are subscribed to, and I have a chat area that I've opened up as well on Substack, where you can leave me messages, and again, kind of like with the open discussion channel on Discord, you can interact with each other and share messages and thoughts as well. So whatever format you are most comfortable with, feel free to go ahead and take advantage of it. Okay. So let's just talk for a minute about what's going on in the marketplace, because it's a little bit hectic, isn't it? Here's the S&P 500, and obviously we're off to a roaring start. The market was down quite a bit yesterday, obviously, as news about tariffs has been made available, and we're all trying to digest what that means. So let's just try to put this in perspective, because it's easy to see. I need to go grab my drawing tools again. Just a second. It's really easy to look at what's going on that chart right now and to automatically assume the worst. Because let's face it, movement like this from about, what is this, 5,600. This is about a 400-point drop in the S&P 500, almost 10% in just 2 days. That's pretty significant. And on an individualized stock basis, that also means that we've seen some pretty significant drops in price. In previous webinars, and we had the market, in this neighborhood, I talked about corrections versus bear markets. And the truth is that even down here at this bottom at around just a little bit above 5,500, the market had only dropped by about 10%, maybe a little bit more than that. So it was still only actually in correction territory, which is obviously more serious than just a regular pullback, but doesn't equate to bear market level kind of activity. So what about now? Obviously, we don't know how the market just kind of keeps pushing lower here in the first few minutes of the day, but we don't really know where, and we don't really know where it's going to bottom, because we're literally just at the beginning of the trading session. But let's just go ahead and work with the ranges that we have here. So I've traced this line from the top of the market, which is at around 6150. And now we're down here at 5250. So we've given back literally 900 points. That's significant, right? But let's put this in perspective, because again, we want to try to consider whether we're actually in bear market territory. You're going to hear a lot of talk about bear markets. We're going to hear a lot of increasing talk about recessions, and I think all of these are possible. But they're not foregone conclusions. Doesn't matter how much of what we see, everything is red here, and that's really, really scary, right? But we want to try to avoid the emotional reaction here and try to put things in the most objective format or perspective that we can. Context. Thank you. That's what I'm looking for. So let's divide that 900 point drop by 6150. And what we have is 14.6%. That's how much the market is down now off of this high that we saw back in February. Serious? Sure. We've seen a lot of, I'm sure that you're looking at stocks that are down significantly from the prices they were at. If you've been working with some of the same put selling trades that I have, you've seen some of those stocks make gaps of their own in the last couple of days, as the market has been selling off. And I'm not going to minimize that or talk or dismiss it at all, because those are significant drops, and we're extending it a little bit more. So let's just go ahead, and I'm just going to round up here, and I'm going to call it 15%. At 15%, we're still in correction territory. We're still 5% away from an actual bear market. So we have to cross below 20% before we can realistically start talking about bear markets. Now, just so that none of us are taken by surprise, let's talk about where that actually would be. Let's multiply 6150 by 80%, 4,920. I was paying attention to some commentary last night that was saying that they didn't think this level was too far off, and that according to the analyst that I was listening to, they thought that it was a foregone conclusion. But the truth is, we're still about 300 points away from this. This distance could get covered in relatively short order, obviously, based on just the last 2 days, right? But we're still not there. And that's a level we have to cross below before we can really, really start talking about legitimate bear markets. I think even what we're seeing right now is a lot of we talk about, there's a lot of sayings we throw out there in the market, like, and one of them is buy the rumor, sell the news. Well, here is where buy the rumor was happening a little bit. We knew tariffs were coming. We were hoping that maybe they were just negotiating tactic. Maybe they're just a big stick being used to try to push negotiations. And here's the reality. Here is what happens when they actually take effect. This is buy the rumor, buy and sell the news. Now, at some point, the market is going to come back to some sense of normalcy. This is an emotional reaction to the reality of tariffs and potential trade war, and that does mean that risk is increasing. I want to be clear about that. This does mean the risk in the market is increasing on the downside, clearly, and so that does mean we need to be very careful, very cautious, conservative about taking new trades. And when we do take new trades, this is a great opportunity for me to bang my good old position sizing drum. Um, Make sure that you're always trying to use the most conservative position sizing principles that you can think about. Uh, I've been trying to keep my position sizes no larger than about 3% lately. With with market activity picking up on the bearish side right now, I'm going to try to shorten that even more and be more like 2.5% on the outside. And if I can be below 2%, then I'm going to try to stay below 2%. That means that the income I'm bringing in from my trades is not going to be as much on a per trade basis, but it does mean I'm still going to be able to function in the market. And it's also going to keep the overall exposure in any one trade that I make as conservative as possible. It doesn't mean that these kinds of drops we're looking at aren't significant, because they certainly are. But it does mean that we can put them in a little bit different kind of context. They become a little bit easier to manage. Now, with that, I want to pivot a little bit. I've been talking a lot here for the first 11 minutes of the session today. I want to try to encourage some participation from you. Given what's going on in the markets, what are some of the things that you're planning to do to try to protect your own accounts? Are there some other ideas that you have that you've put together that you're going to be working with? Go ahead and drop your thoughts in the chat. And while you're doing that really quickly, I'm gonna just gonna throw in my email address here in the chat as well, in case you have other questions you want to message me during the week and would prefer to send me email. You can do that by sending me rebelincomesystem@gmail.com. So Jay, thank you. Interesting that GIS was up. I agree with that. I'm not going to be claiming any kind of foreknowledge, but this is, we talk about trying to be defensive. One of the things that we have seen is that companies that are a little bit more defensive in nature have tended to hold up a little bit better over the last couple of days. Also, one of the things that's really interesting is to try to find companies, and industries, sectors, or individual companies that are a little bit not exactly immune, but don't have the same kind of exposure to tariff risk, right? Um, it's the simple fact is that not every publicly traded company is importing products from outside the United States, nor are they exporting. Some are operating entirely within the United States, and so in those cases, exposure to tariffs is going to be relatively minimal. Now, that doesn't mean the stocks aren't couldn't experience some volatility just by association, but it does mean that we're less likely to see real tangible effects on bottom lines, on revenue, on all of those other things for those kinds of stocks. GIS doesn't exactly fit into this category, but it is a defensive stock, and just by virtue of being in the food products industry, and so I think that one makes some sense. And we're seeing some of the same kind of behavior in a lot of other stocks in the food products industry. Tyson is down today, but is actually holding up better than expected. For example, here's just a few that I follow quite a bit. Conagra, holding up pretty nicely. So there's some not exactly bright spots necessarily, but some silver linings, perhaps is maybe a better word. So Gibbs says relax, and Jay, you also added wait and see. I think that there is something to be said for what you're talking about. Um, and one of the things that along those lines may help you to relax and be patient, wait and see. Um, the market is it's not something that we have to be in front of all the time, right? It's not a given that you have to take a trade every single week. Now you're going to see me trying to post trades every single week, but it is also possible that on any given week, if I just don't like the opportunities that are out there, I may go ahead and say, guess what, guys, this week it's just not working out. We're going to wait a week, and I'll pass on highlighting a trade if I think that makes more sense. I've done it before, and I'll do it again. Sometimes that's okay. If you feel like you need to take a holiday, maybe take a vacation from the market for a little bit, just disconnect from it and go go play with the grandbabies, or just find something else to do. Find a fishing hole, play around play around of golf every day for a week, whatever. That's okay too. Um, the market's going to be here. There's always going to be another trade that we can find and take advantage of. Now, I will say, if you are planning on doing that kind of disconnecting, you want to be careful about you want to be careful about not leaving any open positions in the market, right? Because if you do have open positions, you should be checking on those every single day. So thank you for those thoughts. I appreciate that. Another thing that you could consider doing, and I've written about this in the past, and included a note about it in yesterday's Thursday article. If you read that, is you can also, when you take a new position, you can also consider adding an element of insurance. When we're talking about put selling as a strategy, or buying a stock outright on the basis of value, you're immediately exposed to downside risk. If the kind of thing that is happening in the markets right now uh, persists for a long time, there's Suncor. Look at that. That's a pretty steep drop right there. And this one's not too surprising, right? Because Canada is one of the primary targets for tariffs. Now, this is one that I think Suncor is an example of a company that has less actual tariff exposure due to the way that it does business. It doesn't import a lot into the U.S. At least when it doesn't use U.S. ports for its exports, I should say. It uses its own. It uses Canada's own shipping ports on the East Coast as well as the West Coast. And so in that sense, it's probably got a little bit less exposure to tariff risk. But what we're seeing here, it's clearly at the very least, a sympathetic reaction, just because it is a Canadian company. So that's also interesting. So one of the, as I was talking about, sorry, I got a little bit sidetracked by looking at Suncor. One of the things that you can do here when you do take on a new position, whether you're buying a stock outright or you've been selling puts, Every week I post a bull put spread trade as well. Bull put spread means that along with selling the put option, you're also buying a put option at a lower strike price than the strike price that you sold. By doing that, you put an effective limit on how much downside there is. So the long put gives you acts as a hedge. Um, let's go. Let me switch over here. Just going to go to the trade alert I posted for this week on GIS. And let's talk about this bull put spread for just a second. Now the stock has been moving nicely, so maybe this wasn't the best trade for GIS, but this is the most conservative one. And the reason for that is because of the put buy leg. So in this case, selling the 60 put, I suggested or highlighted buying the 57.50 put to set up the bull put spread. So what that does is that gives you a $2.50 difference between the two strike prices. And that starts to define what the overall risk is in the trade. It doesn't mean that this is the amount of actual risk. This starts to give you the context to frame that risk around. Now, the next step is to think about the money that you bring in from the bull put spread. In this case, the net credit was 85 cents. So you subtract 85 cents. And don't worry, I'm not going to do this in my head. We know how that works out for me. So that's $1.65. This means that no matter how far GIS could drop, if it does, the total risk per contract sold with the bull put spread is $165. That's it. Sorry, I just saw that this does not show up. So give me just a second. Oops. Let me rewrite this. Okay. Was not paying attention to the rectangle where my camera shot is. So $165 is the total risk in the bull put spread. So one of the things you can consider if you do decide that you want to place one of the trades that I'm highlighting and you want to make it more conservative, a bull put spread is a really good alternative, a way to make this a lot more conservative. It doesn't mean that you're not going to take a loss, but when you can limit it and you can define it this way, then you can start to manage those risks more effectively. You can start planning in very practical terms what kind of risk you're willing to take in each of these trades. That's why that's the main reason that I include bull put spreads at all times under all market conditions, is just because this is a more conservative way to approach income generation. And it's when the market is starting to increase in its level of downside risk, like we are clearly now, I think that makes more sense. Now, you can also do the same thing on stocks that you own, whether they're from put sale assignments or you bought the stock outright. If you want to try to protect try to limit your downside. Good morning, Barry. Glad you're here. No worries at all. We've just been, trying to figure out what's going on in the market this week. And right now we're talking about some things that we can do to try to manage, I should say, manage and limit risk a little bit. Talking about the value of the bull put spread trades that I like to highlight each week. Another thing you can do is to buy a put option against a stock that you own. Literally, this is like taking out an insurance policy because it's a little bit different than a bull put spread because you already own the stock. There's no time limit associated with those shares, right? Let's just go ahead here, and I don't have any trades that are set up for expiry this week. So we have GIS, which is everything is set up for the 17th right now. So we're not really anxious on anything, but I do want to, I was kind of impressed by SU. A little bit grateful now that option expired. Worthless last week. Well, let's talk here again for a minute about some of these stocks. So here is Skyworks. Okay, I am long this stock from being assigned here back on March 21st. So let's go back over here. Let's take a look at the price. And again, just for perspective, I was assigned at 67.50. Stock's below 55 now, picking up bearish momentum. Let's look at the chart. We'll see the same thing. Had dropped a bit from the price that I was assigned at, obviously, but it's picking up momentum in the last 2 days. We still don't know where support is for this stock because it's just piercing and making new lows. In fact, wow. It hasn't been this low in quite some time. That's pretty remarkable. So if I'm in at 67.50, which is going to be, around here, the stock is now down here at about a little bit below 55. One of the things that I could do now, the idea here is that you've done this before you see the kind of drop that we're talking about having happened. But if I wanted to try to make this a little bit more conservative now, one of the things that I could do is I could go and I could buy a put option. And let's expirations. Let's go out to as many expirations as we can get. There we go. Okay. So let's go to let's go 6 months out, shall we? Let's go to September. And we could buy the 55. This is just an example. As always, this isn't a recommendation to place an actual trade. I just want to use this to illustrate the method. I could work with the $55 strike. If I'm really afraid that Skyworks is going to continue to drop even further than it has, by the way, Skyworks is in its own bear market, right? Or very close to it, I should say. if I wanted to try to protect that risk of an even more extended and protracted drawdown, correction, bear market, whatever you want to call it, then I could buy this put option at $7.80. Now, buying it means I'm paying the premium, not bringing it in. That's why this is something I would think of as an insurance policy. I am talking about buying 6 months of time here as well. So these are all components that are contributing to this overall cost. The idea here is that if the stock continues to drop, then the increase in the put option will not completely offset, but at least partially offset some of the decline in the shares that I own. If that drop happens, if you see the stock drop quickly, you see the price of the put option change materially, then the idea is that you can sell the put, bring in the cash from the gain, book that profit, and then immediately buy another one. Otherwise, the idea is just to hold on to that put option that you've bought for as long as you can, and it may expire, but let it. This is literally like, I've used the term already. This is literally buying an insurance policy against your stock. So just like we pay insurance premiums and forget about them, we just hope we never actually have to use the insurance that we're buying, right? It's kind of the same way with these. For that reason, a lot of people prefer to work with shorter term expirations when they use this is a strategy called protective puts. They may work with shorter expirations. So, for example, if I wanted to do that, I could go out a month. 42 days is the nearest to a month right now for Skyworks. And so I could buy the 55 here for 470, quite a bit lower cost for 1 month. Again, if the stock drops quickly, it should help to minimize some of the loss in the stock. The extent to which that is going to happen is obviously going to be determined by delta values and how much the option is going to change in value relative to a drop in the stock. So let's go to the Greeks here just to show you what I mean. Here is the $55 put. This one has a delta value of about 46 cents. So for every dollar the stock drops, this is going to change in value by about 46 cents. So about 10% of the overall price of the stock right now, or price of the option, I should say. A little bit under that. For some traders, the preference when they're going to work with this is to try to find a delta value as close to 1 as possible, and that may be the reason for buying more time. Or not. Let's go back here, and you can see we're getting closer to 1 when you buy deeper in the money. But again, you're going to pay a higher premium for these. If you can get to a delta of 1, that means you have a dollar for dollar difference between the change in price in the stock versus the change in price in the option. And so if you want to be really conservative, look for a delta value as close to 1 as you can get. Decide whether or not that's a premium you're willing to pay. My preference is to pay less premium as much as I can, and to think about the move proportionate to the prices that I'm working with. And it does mean that I'm accepting a little bit less. If I use a protected put the way that I prefer to do it, I'm not going to minimize the loss as much. But the primary purpose here is just to try to help me mitigate risk, help me manage the position a little bit more easily, so that I can make better decisions about those about the stocks that I'm trading as they're experiencing these periods of increasing risk. Does that help? Does this make sense? If Gib, why not a covered call? That's another possibility. What I'm really taught, thank you, and I appreciate that question. The reason I'm not talking about a covered call here is because I'm talking about ways to intentionally make your trade more make the position more conservative and try to actively limit downside risk. Covered call technically doesn't do that, because if the stock drops, you're just the your price is going to continue to drop. Now, the covered call does help to lower your net cost basis, but if the stock is really, if bearish momentum on the stock is really picking up, like we're seeing here for Skyworks, right? Or here's Nvidia, everybody's darling. Let's see, Tesla I know was getting hit. Let's see, let's think of some others. There's Microsoft. You know, when you see bearish momentum really starting to accelerate, these can be some ways that you can try to minimize some of that really rapid decline rather than a covered call. Covered call is going to be a little bit more limited. And the flip side is, if you're wrong about the pace of the bearish decline and the stock starts to reverse quickly, you could suddenly be in a position where you may be looking at being called out at a lower price than what you bought the stock at. So if you're gonna sell a covered call with a lower strike price than your purchase price, you have to be ready to be nimble if the stock suddenly reverses to the upside. Hope that makes sense, Gib. Barry, ultimately, don't the money people that make up the market pretty much control all this? If they don't panic, not much will change in the market. Well, there's some truth to what you're saying, Barry, to be sure. At the same time, the market is an emotional animal. Here's your proof. The money people that make up the market are still just people. And so let's not give them too much credit. They're emotional animals just like we are. And so that doesn't necessarily discount what you're saying, but it does mean that I need to be willing to account for the fact that sometimes these kind of drops are going to happen. Here's the Dow Jones. That's down about, let's see, what are we, from 450 to 394, almost 60 points. Still not quite a bear market. It'd have to be about 900 points from the top before we'd have a bear market in the Dow Jones. Here's the NASDAQ, NDX. From a peak at around 22.1. So it lost about 5,000 points. So it's a little bit closer to bear market territory than the other two, but it's still not quite there. So these are emotional responses by the money people that make up the market. And so these are things that we can, there are some things we can do ourselves to try to limit our exposure in the trades that we make. So yes, up to a certain point, I do agree. If they don't panic, not much will change in the market. At the same time, there are things we can do on our own actively to try to control and limit the amount of risk that we're taking. So I never try to turn a blind eye. I try to not just say, well, it's all going to work out in the long run. As long as I'm focusing on value and I'm buying good value companies, in the end, in the long run, they should end up being higher than where I bought them. That's technically true, but that doesn't mean that sometimes there's some very steep declines that you have to be willing to endure. And that's a hard thing to do. And so, what I'm talking about are some ways to try to minimize that risk so that the emotional impact of some of these declines that you end up seeing are a little bit more manageable. I hope that makes sense. Yeah, Barry. Again, I feel your pain. Believe me. I know it's temporary, but my IRA is really ugly right now, down about $12,000 over the last couple of days. Yeah. That's why I say this happens. This is a gut punch. What we have to do is try to figure out what we need to do about it. If you're in some positions that you think are a little bit more heavily exposed to tariff risk than others, then I think your evaluation is a little bit different than what you may do with something that you think is a little bit more protected. Um, because I don't think this fear is going to go away quickly. I don't think it's going to, next week, we're going to turn around and people are going to say, oh, wait, it wasn't all that bad after all. I think this could persist for a little bit. I'm not calling for a bear market, but it also, to be honest, it wouldn't surprise me at this point. So if you aren't thinking about some things that you can do to manage and minimize risk, this is a good time to start doing it. Yeah, thank you, Gib. Me too. So we not to dismiss anything, not to make light of current situations at all. Obviously, that would be foolish. Um, but just trying to put things in context and trying to think about how to try to manage the positions that we're in from a practical standpoint. Now, I already looked at GIS, just talking about open positions, and this is one of the, it is nice to see that this is one of the rare divergences in the market right now, where the stock has rallied nicely above the strike price that I sold. Still a couple weeks to expiration, so we'll see how that one plays out. Skyworks, I am pretty confident in saying that I am not going to get called out of the stock at 70 on the 17th of April. Just speculating a little bit. The stock has got about $16 of distance between the covered call that I sold, right? So I'm going to say that that's a little bit. Here's the covered call. So that's got a ways to go. I'm going to be holding on to Skyworks for a little bit. Barry, on a brighter note, I chose the cash election for my Paramount shares for $15. Cost basis is around $11.40. Nicely done, Barry. And actually, I'm going to go ahead and give you 5 for Paramount. That's Para. Just because it's been such a dog. So nice. That one's actually holding up a little bit. That's interesting. Okay. Put sale on FCX. Here we are. Here's a mining company. Again, expiration on this one is 4/17. I sold the $40 strike. Looks like I'm going to get assigned. A lot of momentum on the downside on this one. So this is looking pretty serious. Now, if I'm not afraid to take that assignment, and I'm not, I like it at 40. Fundamentals are good. The value proposition was nice at that level. Freeport McMoran is not going away. If I like it at that price, then when I take that assignment, a protective put might be a smart way to think about how to manage that risk. Just take out that insurance policy. This is going to adjust some of your position sizing and trading frequency because you're going to be paying money for these long puts to take out these insurance premiums on the stocks that you own. And then if they continue to drop, so be it. You decide whether or not you want to keep working with the stock, or if you just want to go ahead and close it and move on. Check in with gold really quickly. Sorry. Barrick. There we go. Barrick also, it was volatile yesterday. Thought it was stabilizing a little bit. Came up here to about 1950, but it's clearly seeing some drops here as well. Let's see. Talking about HAL, covered call on this one on 26. This is also the price that I was assigned at. So we're in the energy sector now, which we can expect to be volatile around tariffs. And that's exactly what we're seeing. Here's the price that I was assigned and that I've sold. Stock is now down around 20. So I'm going to hold on to these shares a little bit longer as well. I don't know where the bottom is. I am not going to try to say that I do. Right now, everything, all expected support levels for most of these stocks are being broken. Let's switch the view here. We're seeing the stocks break down to levels that haven't been seen in a number of years. Last time Halliburton was down here at around 20 was during the pandemic. And before that, it was, here's financial crisis. Last time it saw this kind of big decline, there's the dot-com bust. So, you know, we're seeing a lot of these stocks that are starting to push these historical lows. That means that I don't know. It's hard to predict exactly where the bottom might be. At the same time, you know, if the fundamentals are still solid for these companies, and they are, then at some point the market should return to some sense, maybe not of normalcy, but of rationality a little bit. Maybe the bottom is in November 2030. Oh, Gib. Thank you for that. Just a thought, kind of a dark one, right? But I appreciate the humor right now. That's, in fact, I appreciate that flavor of humor right now. Barry, my closed-end funds and ETFs are even down a good bit. Yeah, they don't tend to change much with the market. I have a collection of those just for the cash flow with distributions. Yeah, everything is going to be experiencing some increasing volatility, and it is the rare stock that is going to be the exception to that rule. It is going to be hard to find stocks that are going to be bucking the market right now with the way that this momentum is going. This is why I was saying that it may be it's okay to think about maybe I need to pull back for a little bit, give the market some time to normalize, stabilize, whatever you want to call it. Here's CVS. This is interesting. It's actually been quite a bit more stable than most of the rest, even though it is down about 2% today, a little over 2%, excuse me. Let's take a look at Walgreens. 3% drop. Down around 10, but considering where it's been, that's not a huge drop. GES has been falling for a while, but is actually up a little bit today. Yeah. Would not expect that for a consumer discretionary. But I'll be honest, I haven't done any analysis on these guys in a while. So very interesting stuff. Right now, the market is still reacting to the reality of what very functioning their anxiety meds, so CVS and WBA may prosper. Fair, that may be true. You sidetracked me just a little bit. Hormel is bouncing a little bit. That's kind of nice. That is another divergence. Food products. I saw some news that the worst of the bird flu seems to have abated, and egg prices are starting to stabilize, starting to even drop a little bit in most areas of the country as production is starting to ramp up. And not only are our chickens not dying, farmers are starting to see their chicken populations increase as well. So egg capacity is starting to increase. So that's a positive. There's very few here that are going to be bucking the market right now. This is a case where the market is. We have the reality of tariffs, but what we don't have, what is still unclear, is what their overall net effect is. Right now, what we have is a lot of commentary to the positive and the negative, to both sides of what the net effect of tariffs would be. So the truth is that anybody who claims to know what's going to happen as a result of tariffs, they're not necessarily lying, but they are speculating, and they are speculating about something that they have just as much chance of being wrong about as being right. Tariffs like this haven't been wielded in the United States for over 100 years. So we'll see how this works out. I'm not in the camp of I saw one article this morning as I was prepping for this live stream. I saw one article that said that the Trump administration is trying to destroy democracy, that the reality of tariffs is a failure of democracy. I'm not sure that I believe that. I'm not sure that I agree with that. That is a very emotional reaction and a very extreme opinion. Am I worried? Sure. I'm also willing to let it play out. And let's see what the net effects is. As an investor, I want to be politically agnostic about this, and I want to try to think about what all of this means in the most practical terms that I can. That means I'm going to think about what I need to do to try to manage and minimize my risk while figuring out how to continue to be functional. I am not the kind of person that wants to go all in cash. And I said earlier, if you decide you want to if you want to take a holiday from the market for a little bit, that's fine. That should be fairly limited, because you don't want to be away from it for too long, because there's going to be opportunities you're going to miss, and I don't want to miss those. So what I really want to do is I want to figure out how to respond to the current conditions that are there in the market, and what are the things that I can do with the investments that I'm making. Barry, I sold a $55 call on the PPC, Pilgrim's Pride, signed at 50. Okay. Now we'll get the $6.30 special dividend. Yeah, now the call strike is 48.70 because the strike shifted. Yeah. PPC is also holding up a little bit better, relatively speaking. Yeah, WBA is selling out. So you may be paying attention to some news that I have not, to be honest. And that is on me. So if you have some more information about that, feel free to share with the group. I had not seen anything about Walgreens being sold. Here we go. So they are being taken private. That's interesting. That's going to impact the decisions we make, certainly. That deal will almost certainly be subject to FDA, or excuse me, not FDA, but regulatory approval as well. So we'll see. Barry, it does seem right. I can get called out at 48.70 when I set the strike price at 55. Yeah, that's interesting, Barry. I'm not sure. Now the call strike is 48.70 because the strike shifted. Might want to talk to your broker and find out how that happened. I don't have an explanation for that, Barry. There's the one you're talking about. Why would it shifted to 48.70 instead of 53? Why did it shift at all? Special dividend. I've never heard of a special dividend being paid out and suddenly changing the way the options chain was working. Yeah. Jay, thank you for being here. Everybody, we are at about time. Yeah, I'm interested in seeing what the broker says. So you want to message me with whatever you find out. That'll be interesting. Maybe it's because of the special dividend. That's the only thing I can think of, but I've never heard of that happening before. So please feel free to share it with me. I'm very interested. Everybody, thank you so much for your time. I really appreciate you being here and your participation. If there are questions between now and next week, as always, feel free to let me know. rebelincomesystem@gmail.com is the email address. Feel free to message me on Discord or on Substack, whatever your preferred method is. And we'll talk again next time. Thanks again. Bye.